In this session, we will discuss the SDGs and point out significant trends, practices, and new financial tools in the ESG investing arena. For this discussion, please welcome our panelists who represent different players within this industry and will provide us with their take on opportunities and challenges in the field. So please welcome Mr. Wheelan, the co-founder of Response Global Media and managing editor at Responsible Investor magazine. Thank you for joining us. Mr. Will Pomroy, lead engager of the Hermes SDG engagement equity strategy at Hermes Investment Management. And Ms. Heather Lang, executive director of Sustainable Finance Solutions at Sustainalytics. You, Will, and Heather, thank you for joining us today. So we'll start with the broad perspective of you. And please, could you share with us, you've been covering like the field of sustainable investing for a while, since your time in the Observer and the Financial Times, and today at Responsible Investor. Could you please give us a quick overview of this evolving market? Who are these new investors? Who are the prominent players? Some of them we have seen before. How do you see the dynamic change in the past decade, maybe?
Thanks, Itamar. This is an interesting experience to speak. Oh, is it on?
I think now it's on. Try again.
Is that okay?
Yeah,
okay,
now we can hear you.
I can hear myself as well. It's great to be speaking to this audience here. And as I mentioned earlier on stage, you know, and Itamar just mentioned, I'm a financial journalist by background who started a dedicated media to look at ESG and sustainable finance called Responsible Investor. And our readership really is indicative of where this market has come from and is now. So who are the readers of a publication like Responsible Investor? They are the world's big asset owners. Ulrika just described a few of those: pension funds, sovereign wealth funds, foundations, charities, faith investors, big broad spectrum of actual owners of assets, and the service providers who manage those assets on their behalf. And I think probably the best way of sort of encapsulating what that market is, the UN Principles for Responsible Investment, 2,000 plus signatories now, 70 trillion in assets. These are big broad brush figures, but they're indicative of the size of the interest in ESG information and how it drives value within corporations. We're talking about shareholders and the companies that they own here, and the desire to really understand sustainability themes, and we don't need to go back through those, as drivers of both risk within companies and return potential for those companies. And we're seeing a lot more, as we've already heard, of regulation and other issues that and just value creation and destruction. I think I've written hundreds of stories where you see company share price value drop by 20 to 30% in a single hit because of a particular financially related sustainability issue. You can sort of, I'd like to bracket it like that. You know, we're talking, you know, company value now is something like 60% in the brand and the reputation of an organization. So value can be destroyed really quickly. But broadly to your question, the world's biggest investors now are focused on these issues because they matter financially. And they also matter societally, and investors do not operate in a vacuum. Their decisions matter for the big societal and sustainability questions that we talk about. They are not immune to being looked at for what their response is to issues like climate change. So, you know, I'll leave it there.
And could you maybe to move to the investors fiduciary side? The UN Secretary General Antonio Guterres, in the last General Assembly, in September 2018, he reiterated the importance of the private sector role in achieving the Sustainable Development Goals, the SDGs. In reality, where governments are far from having resources to do so, could you walk us through Hermes' decision to go with SDG-aligned investments, and what drove the decision and what did it entail?
Absolutely, and again, as per the previous speakers, thank you very much for the invitation. It's very good to be here. I suppose just very briefly for those that might not be familiar with who Hermes are.
Yeah, of course.
I think Ulrike made the point that maybe Danske Bank are the drop in the ocean compared to Blackrock. Well, I'm not quite sure therefore what Hermes might be. So Hermes historically has always been, or was until earlier this year, entirely owned by the largest UK corporate pension scheme. So we've got a long heritage in being owned by an asset owner. And that means ESG integration has always been built into what we do, because we recognise that what we're doing is on behalf of those pension beneficiaries, and we're trying to deliver the return that Amber was describing, but also hopefully that world that they're going to be retiring into. So we manage about $40 billion of assets under management, and we are fundamental stock pickers. We also have a stewardship business that engages with companies globally on ESG issues, and they engage on behalf of about $400 billion of assets under advice, and that's under advice rather than direct management. So we've been doing this ESG integration and shareholder engagement now for the best part of 20 plus years. I think to your question of why we have gone from ESG to, I guess, impact is what's the word that's behind me, or the SDGs is the kind of framework that we're using to try and think about this concept. And I think that speaks to the fact that I think there's a broad recognition, I'm sure we'll have consensus as we go through these discussions, that ESG supports risk-adjusted returns, i.e., those companies that think about environmental, social, governance issues are less risky investments. I think where we're getting with the Sustainable Development Goals and the kind of look forward to 2030 is a recognition, both, as you made the point, that the UN recognises that private sector investment is needed to deliver on those goals, but also that I think our portfolio managers are recognising there's a growth element to this, there's a return element to think about those companies that are thinking about their wider role in society and the opportunities that come with that. So rather than just thinking about perhaps the risk-adjusted part of ESG, we're now thinking about our companies thinking about those new opportunities, those new product developments, their ability to appeal to a new customer base and create new markets. A company's future growth, as per the MasterCard presentation earlier, they're only going to be prosperous and profitable in 10, 15, 20 years' time if we have a future that is prosperous. We have inequality and therefore inequality minimised and people therefore able to afford the goods and services those companies are trying to sell. Mm-hmm.
And maybe a follow-up question, because it's very interesting that the like moving from risk to opportunities. How did it affect the engagement with the companies? Because it's like suddenly it's like different approach. It's like, could you elaborate a little bit about that? That's very interesting.
Actually, I think you're right. It is absolutely a different approach. So we've been speaking to companies for 20 years about corporate governance in particular, absolutely to Amber's point that executive remuneration, the board of directors, the kind of governance risk, and understanding that governance at the board level is fundamental to our assessment of a company and whether it's a good quality company that we want to be investing in. So they're very used to us and Amber and many of our colleagues around here turning up and having those sort of conversations and using our voting right at the AGM and trying to hold those directors accountable. I think what they're perhaps not so used to, and certainly not so used to portfolio managers doing, is turning up and having a conversation about how that company's business model fits into a world that's changing rapidly. There are lots of kind of competing forces, and trying to almost have the conversation about how that company is an agent for that change. Rather than reacting to the change, how can they play a part in creating change in society? And actually, I think the human capital piece that's come up quite a few times during the conversation already today, I think that's the almost direct way into this conversation, because companies are employing people. On the whole, they're employing less people, but they are still competing actually for an ever more scarce resource around some of the skilled labour. And those employees tend to be their greatest advocates. Mm-hmm. And also they're their connection to society. So again, thinking about, in particular in the US, how companies might have a greater responsibility to take on some more paternalistic responsibility and therefore increase their brand, but also increase their kind of productivity base, mm-hmm. is a good way into trying to open up a more holistic conversation.
Yeah, and I think it's also like in some way as an indication of like how companies can stand out. And regarding if you're like looking into opportunities, and I think especially Israeli companies, this is a really good news on this issue. And let's hear some more. New financial tools. Heather, you're leading the Sustainable Finance Solution Unit at Sustainalytics. As an experienced professional in the sustainable finance industry, could you please share with us some of the existing financial tools in the market? Who are they useful for? Any specific type of company or sector?
Sure, thanks, Itamar. Can everybody hear me okay? Okay. I also want to just start off. Toda rabah. שאני מאוד שמחה להיות כאן היום. It's really a pleasure to be back here at this conference and to be in Israel.
You're showing us all up now.
That was on purpose. And yeah, maybe just a few words about Sustainalytics. Sustainalytics is a global leading ESG research provider for institutional investors. We work with clients like Hermes and Danske and Blackrock and many other large global investors. And our primary business is very much oriented towards those investor clients. And what we do is we do research of thousands of publicly traded companies globally, and we assess their environmental, social, and governance performance. And our investor clients use that to develop all sorts of products and strategies informed by non-financial factors, which can sometimes have material implications for their investments. Today I'm actually leading up a team called Sustainable Finance Solutions, which you mentioned. It's a slightly different, it's sort of a business unit within the company, and we're working more directly with corporates and with financial institutions on, again, that opportunity side of it. Of course, you know, building on the notion that there are risks and environmental and social and governance risks that companies face. We're really focusing in on how they can address some of those challenges and how they can allocate capital towards a low carbon economy. And I think, you know, to speak to Ulrika's point actually earlier on about the onus on a bank or on a financial institution to really be a part of the solution, I think is really the world is looking to financial institutions, to companies, and to see how they can become part of the solution, not just making themselves less bad, but actually being part of that solution. Mm-hmm. And so some of the innovative new tools that my team is overseeing right now and working together with both corporate issuers as well as underwriters are green, social, or sustainable bonds as well as loans. And maybe just at a high level, I'll explain what that means. I mean, basically, a green bond is just like a regular bond, except the idea is that it has a very explicit use of proceeds that's focused on impact. So there's green bonds, which are focused obviously on environmental projects and solutions. There's social bonds focusing on social issues. And then we use the term sustainable bond as a little bit more of a hybrid type of bond that could be addressing social and environmental issues more broadly. And often the SDGs are used as a framework for identifying some of the different use of proceed categories that we're facing.
Maybe could you try to in order to try to make it more tangible, like some kind of an example or a case study of like one of like green bond or another product that you're working with a company now?
Yeah, sure. So I guess maybe just to explain what our role is in relation to the bonds, because obviously we're not the ones issuing them and we're not underwriting them either. Where Sustainalytics comes in is as an external second-party opinion. We're basically assessing their credibility. We're making sure that there's no greenwashing. We're making sure that that the use of proceeds are aligned with key global standards. We're making sure that the issuer has a commitment and a credible strategy around ESG, and we're making sure that it's aligned with investor expectations. So we've provided these second-party opinions for over 200 bond frameworks over the last few years. It's a market that's grown really quickly, and you know, outside of the usual suspects where you'd expect to see a lot of issuance of green or sustainability bonds like in Europe and in North America. And we've been increasingly going into Asia Pacific, working with Korea, Japan, even China, to support credible bond issuances. And maybe the case study that I wanted to highlight is with a Turkish bank that it's called TSKB, and they came to us a couple years ago. It was back in 2016, so still fairly early days in this industry, and you know, to really sort of build on their broader sustainability strategy to position themselves as a leader both regionally and globally, they decided that they wanted to issue a sustainability bond. And that would focus on climate change mitigation, adaptation. It would also focus on social issues like education and health. And it turned out that they issued this bond. It was a $500 million bond. It was heavily oversubscribed. They won awards for Green Bond Deal of the Year by Global Capital and Thomson Reuters and some very prestigious awards. And
actually, for Turkey, it's surprising,
Yeah, exactly. It's not where you'd expect it to come from, but it also, I think, most importantly, it diversified their investor base. These were international investors that came from a lot of different countries. They were also different investor types. They were asset managers. They were development banks, and they were even hedge funds investing in this.
A huge business opportunity for the Turkish bank to diversify.
Absolutely, yeah. They did a second one a year later based on the success of the first, and it's really something that they've hung their hat on and positioned them as a sustainability leader.
Yeah, let's go back to the investor side. What can you tell us about the different approaches of European and American investors? What do you find in each group emphasize what they're looking for in companies? What matters to them?
That's a tricky question. So I think if you're talking about Europe, most institutional investors across Europe are seeking much more disclosure of ESG data and contextual information from the companies they invest in. And for the companies themselves, that means they need to be thinking about the data and information they put together. And this goes actually quite regularly to the investor relations department, because this is business critical information with shareholders. On top of that, in Europe, you have a serious roster of regulatory shifts that are coming in. Amra mentioned one earlier in the Shareholder Rights Directive. There's another huge initiative with the EU Sustainable Finance Action Plan, which is going to bring in a number of different requirements for both companies and investors on ESG transparency, let's call it that for the moment, but also on their approach to CO2 emissions and the energy transition, how they are measured against each other in different indexes, but also looking ahead to the banking and insurance sectors and how large-scale, low-carbon projects that we know we need for the future are going to be financed. There's lots of different debates there about credit worthiness and how credit is analysed and regulated. In the States, it's somewhat different, as you can imagine, but it's also somewhat the same. Actually, big pension funds, some of the biggest pension funds are absolutely looking at the same issues, and why wouldn't they be? Because they're financially relevant. You of course have a pushback on some issues, well actually quite a lot of issues from the government, so there's a huge pushback in terms of shareholder rights, so-called proxy voting around corporate governance issues, which is being debated ferociously at the moment. You also have the pushback from the Trump administration on the Paris Agreement, but actually you're seeing lots of states responding to the issue of climate change with their own regulatory pushes. So a mixed picture, but broadly I think the same types of trends. I mean, Amra was on earlier from Blackrock. I mean, Larry Fink, the CEO of Blackrock, recently said he thought that sustainable investment would be at least as big, if not bigger, than the mainstream investment market. I think that's just an indication, actually, of the importance of these issues, E, S, and G, as an increased palette of information from investors that is related to the way the world is now and the sustainability challenges we face and how important they are to us as a society and to the companies within that. So, you know, there is no geographical zone that escapes from those issues, and there are no companies that will not be affected.
And maybe to take it forward from a global perspective, how would you describe the way that Israel, the startup nation, is perceived by ESG investors? Do you see Israel's innovation and technology translated into an advantage in the ESG investment field? And if so, how?
I think so. I think in terms of technology, Israel is of significant interest to international investors, and I think you'll see some of those technological innovations increasingly being used in the fields of sustainability. I could think of all sorts of examples: smart metering, energy efficiency, production of I could go on forever, but there's all sorts of areas where I think Israel has interesting companies and an interesting way of thinking about sustainability issues as well, actually. There are issues, of course, to the international investment area which need to be discussed, but I think broadly, Israel is a small part, of course, of most institutional investments portfolios, so you can't over-egg that either, but I think you're hearing here from companies that are really starting to think in as sustainability at the heart of the way they're trying to create new businesses. So investors will be interested in that. We don't touch a lot on the impact investing theme actually at its core, which is VC type investing into small and medium-sized businesses that are 100% sustainable in what they do, and that's a really interesting phenomenon that we're starting to see. The big private equity houses in the US launching billion-dollar funds, investing in smaller private markets funds that are financing interesting companies. Impact is also used as a reporting sort of term, but actually impact investing funds generally tend to be smaller private markets type allocations, and I think we're seeing a lot of interest in Israel around that, and social financing as well. Heather mentioned social and green bonds. Actually, social bonds, interesting developments here in Israel, and I think you'll probably see more in the way of green infrastructure projects being financed by debt for particular. Whether that's energy or transportation, you'll see a lot more of that. We're seeing a lot more of that anyway, more broadly. The green bonds phenomenon has kind of moved from just company debt issuance to much more targeted project finance issuance. So very interesting things.
And maybe, considering the complexities and based on your familiarity with the Israeli market, could you give us maybe share with us an example of a different country where ESG has developed recently, maybe that could be somewhere. Israel, in matters of ESG, is still a preliminary market, is still like not developed like Europe in the US. If you have.
I think one thing that's quite a difficult question, but what you're seeing of different financial markets. So let's talk about financial markets, financial capitals. You're seeing that many financial centers are now trying to attract sustainable investment funds or the listing of green bonds into those markets because they want to encourage, they're kind of looking to the future, and they know that actually the product pipeline around sustainable investing is growing. So we're seeing a lot more funds being launched in this area. We're seeing a lot more specific instruments being listed on different exchanges, and many different financial centers are looking to play a role there. And I think Israel also has to think about that, and I think is thinking about that of Israel as effectively a place for sustainable finance to grow. So I think there's always competition. There's competition out there amongst financial marketplaces for growing sustainable finance as a business, and it is the finance industry of the future. So it behoves Israel to be paying more attention to that as well as it already is.
Heather, how do you see the ESG and impact investing field evolves within the near future? Maybe what kind of trends can we expect?
Yeah, maybe I just also want to comment a little bit on Israel specifically because, it's a market and a country that's close to my heart, and I spent a number of years living here. And actually, over the last few days, I've met with a lot of a lot of companies and spoken with a lot of people just to get a sense, and I can even see how much it's developed just over the last 2 years since I was at the Maala conference in 2016. And you know, just picking up on what Hugh was saying, I think there is a real opportunity here in the sustainable finance space in particular, because there is so much sustainability innovation happening in this country, in renewables, solar, in water treatment, desalination. I mean, there's just so much incredible innovation that's happening here, and I think that will, you know, I think that really lends itself, those types of projects and companies, whether they be sort of pure play companies or larger companies where this is a major emphasis of what they do, can really open themselves up to global investment from the responsible investment community, perhaps without, you know, some of the same political challenges that they faced in typical ESG, and
try
really
to stand out with innovation and technology.
Absolutely, I think the opportunity is there, and I know that this is already happening. That I know that a lot of companies are already, you know, investing heavily. Israeli banks. I saw in Bank Hapoalim's CSR report, 6 billion shekels went into renewables in 2017 alone. I think that's a story that responsible investors need to hear. We talked a little bit about materiality earlier, and I think, you know, especially for the banks, that is one of the most material key ESG issues, is to look at what types of products and services banks are developing that address those sustainability challenges and create solutions. And so it's not just, again, about the risk mitigation, but it's really about opening up those channels.
And Will, maybe you could relate to, like, what are your recommendations for companies that are interested in integrating ESG consideration in their business? Why should and how could one stand out from your point of view?
So the question of standing out, I guess, is a $1 million question that I guess all companies globally are trying to address and come up with the answer for. But I would certainly reinforce Heather's point. I think you know, one of the reasons I want to come back to this conference again. I was here with Heather a couple of years ago. Is that the amount of innovation that's happening in Israel? And obviously, I talked very briefly about my fund, which is an engagement fund, and we're engaging with small and mid-cap companies globally around their ability to be kind of agents for change in society and recognise where their strategies might need to evolve over the coming 10, 15 years to continue to be at the forefront of the industries they're operating in. But equally, we've got a sister fund that launched at the same time at the beginning of this year, which I think is more typical of the impact funds that are being launched across the various markets at the moment, which are looking for those impactful companies from a purely product viewpoint, and looking for those pure play companies who are coming up with the innovative solutions to solve a huge range of environmental or social challenges that we are wrestling with over here in Israel, but frankly globally. Many of the issues are global, and at least there are very similar parallels in the US to Israel, to many other markets on many of those points. And whether that be investing directly in some of the Israeli innovative companies that are publicly listed, or it might be finding the practical solution that we can then go and translate to other markets. And certainly for me, that's my interest. But I know my colleagues have been looking at a number of the public Israeli companies and looking at them as potential investment opportunities. So I guess the answer to your question is, you know, sing louder, you know, tell the story better. And as I said, that goes for all companies.
And starting with disclose, because
Absolutely.
It's the first level. You can get to the second level of impact and SDG if you don't disclose.
And so just on the disclosure, there is, and European and US companies will feel this most strongly, there's been a big pressure on them for the last however many years now to disclose A, B, C, D, and that list just keeps on getting longer. And
from different directions.
Absolutely.
Yeah,
so I can understand,
we'll touch it on the next discussion. Yeah.
So I can understand the resistance from companies of disclosing what seems to be an ever longer list of issues. But those companies who are perhaps coming at it fresher, frankly, they've got a great opportunity to look at it with a blank sheet of paper and say, what am I doing, what can I do, and how can I tell my story that will resonate with investors, and importantly, tell it in your main core investor presentations. Tell it to the investors. Don't tell it to the NGOs and the stakeholders and the other parties. Yes, they will be interested. If you're trying to appeal to the investors, make sure it's core and central to your investor presentation and your investor pitch. Otherwise, frankly, it will look like an add-on and a tag-in, and maybe feed into the greenwashing view and isn't really therefore part of your pitch for new money.
And maybe I'll try to an open question about the. We really like to know where does it lead now? You know, in like 3 or 5 years, we're talking about the data is there, and we're talking about we know that it's like profit and purpose, they're not mutually exclusive. We have it's like all out there, all of the research is out there, and we'll touch it also in the next discussion. Where do you see it evolve in the next 3 or 5 years? Just your take on that, because it's like a rare opportunity to hear you.
Just, I suppose, if I go very briefly, I think the 2 new products that I described from Hermes.
That's for sure. Some of the
self-interested, of course, but I do think that they speak to kind of where the future is moving in the investment industry, and that we haven't come up with those products because we've been sat around the table and thinking about what we want to do. Both of those products have been seeded externally from Hermes for the first time, and that's because demand is coming from our client base. And that may be, in some cases, institutional investor, i.e. pension funds, but actually I think it's coming from, Ulrike's point, the retail sector. Not necessarily the kind of us as individuals with our small kind of few pennies, but the big family offices and those large kind of intergenerational passing on of wealth from what was perhaps a long family office of steeped in history. Suddenly this new generation where they're thinking, right, we've got this pot of money, but actually I want to do something more with it. I want to get something more than just a return. And they really are long-term investors, and they are increasingly socially interested in social impact. And they're not satisfied with a report that comes back with a few what can be superficial reporting metrics to say we've done X, Y, and Z, such as speaking with companies about ABC, or investing in companies where a small part of their revenue is generated from something that does good. They want to know that something actually has changed. And engagement absolutely is one of the key levers to bring about that change. It is a soft power mechanism that can bring change within public companies. And that's why UBS, which is the kind of the seed of the fund I'm involved in, have put the engagement fund in their impact bucket, because they think the only way in public markets to create genuine impact is through engaging with those companies and creating partnerships and creating networks of connections, actually therefore creating meaningful and tangible change. But equally, on the product side, the innovation we talked about here in Israel, those kind of core pure play kind of companies who are really looking to the future and kind of pre-investing ahead of time, they will be the successful companies that more and more investors are looking to identify and get in. It's an ever more competitive environment to try and find those.
So your suggestion is like start to disclose yesterday, because tomorrow you'll be could be attractive if you want to build this impact at a second level.
Absolutely, but disclose and report in a slightly more imaginative way than perhaps those that have been doing it for 10, 20 years have been. The Sustainalytics of this world will gather that data and we'll put it out there. But by the very nature of a rating from Sustainalytics, it is backward looking. It is gathering historic data. But Sustainalytics and MSCI and the others are clearly trying to do work to try and be more forward looking. But companies have it in their gift to tell that story themselves and be more forward looking and explain where their strategy is going and how that's linked to the goals and targets set out in the SDGs.
Maybe a couple of more points. Will's made a really interesting point there about contextualizing the reporting of sustainability data. A couple of other big themes, I think, that are going to dominate the way that ESG and impact investing is thought about in the next 5 years. So we know that we have huge requirements for the transition of our society to a low-carbon economy. We know we have governments that have signed up to a Paris Agreement that have nationally determined contributions that are going to feed into the economic plans for those countries over time. The money needs to be found to finance that transition. It's not going to come from governments alone. It's probably not going to come very much from governments. In a sense, it will come from partnerships of governments, the big multilateral development banks, IFC, World Bank, Asian Development Bank, African Development Bank, etc., and private investors of all hues. So that will be big pension funds, it will be foundations, it will be others who are allied into all sorts of areas, whether it's financing infrastructure or financing new economies that are new companies that are benefiting as a result of those infrastructure changes. And we're also seeing interesting themes around sustainability and climate, like changing business models. So circularity capital idea, where companies no longer sell products, they lease products and they recycle them. This is a change of the way that business is thinking about what it does, and there are good business opportunities for companies that seize that trend now and start to think about what it means. Because
what it does, how we create value, yeah.
We can no longer be selling product, effectively selling things out there that cannot be recycled, reused, rethought about in a world where we have serious challenges as a result of that current economic paradigm. It needs to change, and those people, the people I heard described recently as those that look round the bend, that can see what is coming down the lane. That's where the businesses of the next 5 to 10 years will be challenging established players. In fact, they already are. They already have done in the tech sector. They'll be challenging them across all areas: energy, transportation, whatever. All of those big themes. We'll start to see new challenger companies and investors investing in those.
Very interesting, but we will just lacking time. So please join me in thanking Heather, you, and Will. And thank you very much for sharing your experience and expertise. It was insightful. We are now going straight to the third part.